All right. Thank you everybody for jumping on to the UPC Upgrade Partners Capital Investor webinar. We have an honored guest on here, Zach Haptenstall. Is that right, Zach?
Right. Yep, that's right. You got it.
Perfect. So Zach is the owner-operator of the 176 unit deal that we are going to be working on and investing in. And he's going to be able to present that deal to us here momentarily. For those of you who don't know us, I'm Joe Rinderknecht. I've got my partner Brandon Nye on here. We have one other partner, Michael Mahoney, who is in a meeting. He may be here shortly. And then our investor relations specialist, Christine Diamond. So we are Upgrade Partners Capital, where we raise and deploy capital into, multifamily assets where they have exceptional returns. And I'll get right into Zach. The reason why we wanted to work with you guys is, for one, the things that I like to make sure when we're working with a sponsor is the team, the asset itself, the location, and the debt, right, that you're able to get. And so I felt like from those four pieces, your team, the deal brings a lot of ability to enhance investor returns. And I feel like you guys have done a phenomenal job at hedging risk, right, on this deal for investors to really make a great return, especially in this market, which I know I appreciate, which we will all appreciate. And so with that, if you'd like to go right into it,
Yeah.
And I will give.
You want to make me the host, Joe, and then I can share my screen.
Yeah.
I'll pull up the deck and then we can kind of go through it and show everybody the opportunity. And then we can do Q&A at the end for any questions that people have. But you guys also, I know you're recording this, so we'll send out the recording. You'll have the PDF version of this deck as well. So you can kind of take more time and look at it.
So you should be able to share your screen. I gave you, there you go.
Yeah, Joe. You guys can see my screen?
Yes, we can see your screen.
Perfect. Okay. Well, yeah, thanks so much, everybody, for taking the time and really excited to partner with UPC and Joe here as our fund manager partner. And so I'm Zach Haptenstall. I'm the CEO and co-founder of Rise 48 Equity. We'll kind of go into our bios here shortly, but we're really excited about this opportunity. And so, like Joe said, this is a 176 unit multifamily apartment building in Bedford, Texas. So Bedford is a really strong submarket in the Dallas MSA. This is truly infill Metro Dallas. And, this is actually a pretty good story here. So the seller, they have a floating rate loan and their interest rate cap is going to be expiring here in a few months. Okay. They have a Freddie Mac floating rate loan, and Freddie Mac was requiring that they escrow massive amounts of reserves in order to prepare to buy this new upcoming cap. So what does that mean? It means that Freddie Mac, is part of their loan documents, they have no choice, is sweeping all of their cash flow into an escrow account every month. So all their cash flow has been wiped out because this upcoming cap has expired. They're feeling a ton of pressure and distress from interest rates. And so they needed to just get out of the deal. And we're getting the deal at a very good basis, $142,000 a unit. It's 100% classic units, which means that none of these 176 units have been renovated. They all have the original 1980s finishes, old flooring, old countertops, etc. We can go in there and renovate all of the units and really increase the rents, increase the value to get a good return for you guys, the investors. And so we're also excited because we just bought another deal a mile down the street last week. Okay, we just bought a 360 unit deal. And that deal was built by the exact same builder in the 1980s. And it's the same exact floor plans as this property. So this is literally a smaller version of the same building. So we're instantly going to have economies of scale. We'll have over 500 units within a mile radius. It gives us a lot of efficiencies when we go in to renovate these units because they're the exact same floor plans. We can crank through that. Okay. So with that said, we'll jump into it here. This is a disclaimer. It's a 506B offering. So everybody has a pre-existing relationship with Joe or somebody at UPC. This deal is not available to the public. The agenda, we'll go through the sponsorship team, the executive summary of the business plan, talk about the highlights of this investment, the asset itself, Rise Oak Creek. We'll take you through financial analysis, some of the key underwriting assumptions, talk about the macro components of the Dallas MSA as a whole, as well as the micro components of this Bedford submarket. We'll take you through our comprehensive market survey where we've personally secret shopped all of these comps to show you that our post-renovation projected rents are very conservative and in line with what's already being achieved today. Then we'll wrap it up with an acquisition timeline, some of the key deadlines, and then do a Q&A. And I couldn't open your deck, Joe. So just so everybody knows, it's the same return, same economics. It's just that this deck doesn't have Joe's bio in there, but I know you'll send that out and distribute it, Joe. So just for the purpose of this webinar, people know. But Rise 48 Equity is comprised of Vikram Sandhu, our CFO, Robert Shefchik, and myself. We're based locally in Phoenix, but now also have an office in Dallas. And so, we recently expanded to Dallas. You see a leadership team here. We went in there, and before we ever started to pursue properties in Dallas, we opened up an office in December of 2022. My wife and I bought a second home in Dallas. You can kind of see here, we wanted to lay the infrastructure in the Dallas market before we ever started to pursue properties. In Phoenix, we've purchased over $1.5 billion worth of real estate. Okay, over 40 properties, 7,000 plus units. Been very successful with our vertically integrated platform of property management, construction management. We have the exact same business plan that we are doing in Dallas. Okay, and so like we said, we got an office. We have full-time W-2 employees. We now have over 20 employees that are local to Dallas. I'm there every 2 to 3 weeks. Like I was just there a couple of weeks ago. I'll be in Dallas again next week, working out of our office, checking on our assets. And so, we wanted people to know that we're truly committed to this market and we're exclusively focused on Dallas and Phoenix going forward with this exact same value add platform. One of the big reasons that we've been successful in Phoenix the last several years is that in addition to having our property management in-house and our construction management in-house, we completely control our supply chain. Okay, we buy all our materials directly wholesale from an overseas manufacturer. It gets shipped overseas, and we have a partnership with this manufacturer. The manufacturer has 2 warehouses in the U.S. One is in Phoenix, one is in Dallas. Okay, so we have the exact same supply chain, exact same fixed cost, materials, logistics process in Dallas that we have in Phoenix. We renovated over 1,000 plus units in Phoenix the last 24 months with the same process. And we feel confident we can emulate that here in this Dallas market. So you see here, that's all identical. And to give you guys an update, we just to kind of show you that we already have everything smoothed out foundationally and infrastructure wise in the Dallas market. We just bought our first property in Dallas in February. Okay, so just a couple months ago, this is a Rise Highland Meadows, 328 units. Within 8 weeks of buying that deal, we completely renovated all the CapEx items. We did all brand new exterior paint. We renovated the clubhouse, leasing office, new pool area, fitness center, landscaping. You can see here kind of the before and after. This is the before, this is the after, before, after for fitness centers. And we've already renovated 13 interiors at this property and exceeded pro forma rents on every single deal, or every single unit, I should say. Okay, and so we have a lot of infrastructure in place where we can just hit the ground running and crank through these deals just like we do in Phoenix. And so you can kind of see here what the before photo looked like for the interiors and what the after photo. This is almost identical to the finishes that we're going to have at this property we're talking about today, Rise Oak Creek. Okay, it's original 1980s finishes, original countertops for mica, original cabinets, original appliances. We go in there and strip the entire unit down to the studs. We do quartz countertops, brand new cabinet boxes, stainless steel appliances, undermount sink. So it looks like a Class A interior finish, but it's in a workforce housing type of product, which is still affordable and where the majority of the population lives. Allows us to increase the rents, which increases the value and gets us that profit margin for you guys, the investors. And so this is exactly what the scope will look like for every single unit at this asset when we renovate 176 units at Rise Oak Creek. Okay, so we've got all this stuff pretty down and very efficient right now in the Dallas market. Here you see kind of a structure of our vertical integration. So we have the investment company, we have Rise 48 Communities, our property management company, then we have our construction company. We have over 200 plus full-time W-2 employees on full healthcare benefits in Phoenix. We now have over 20 plus full-time W-2 employees in the Dallas market, including our leadership staff, which we showed you, have several years of experience locally in Dallas for multifamily value add. So we've got a lot of infrastructure in place here. And you can see here, since we've started, We've gone full cycle, successfully executed the business plan and sold 11 different deals. Okay, 11 different investments. Every single one of them drastically exceeded projections. We've never done a capital call, never even come close. We don't plan on doing any capital calls this year, next year, or beyond. Okay, and many of you who are familiar with the interest rate environment, investing in other deals may know it's actually very common right now that sponsors across the country are doing capital calls. We've always had, very low leverage, very conservative underwriting, a lot of cash reserves. So we're not in that position. We've distributed over $94 million of cash to investors to date. We do monthly investor reporting. So last week of each month, you'll get a full report on the progress of the asset. We do monthly cash flow distributions. Okay, so you'll get a direct deposit hit your account first week of every month going forward. And we tell investors that we'll start monthly distributions 90 days after closing. Okay, but if we can, we'll try to do it within 30 to 60 days. So like on the last couple of deals we closed in the last 2 months, within 30 days, we were able to start distribution. So, within, 90 days or less, you'll start getting those distributions, hit your account, direct deposit first week of every single month going forward. Here you can see we've never done a capital call. Like we discussed earlier, we don't plan to do any in the future. And here you see a summary of our portfolio. So we purchased 42 different assets now, about $1.7 billion worth of real estate, nearly 7,500 units. You can see here we've sold many of these deals. And this is a summary of the track record, kind of show you guys what the projected returns were before we bought the deals that we've sold and how they actually perform. So this is the 11 deals that we've purchased, executed the business plan, and sold and gone full cycle. So you see here for each one of these assets what the projected returns were for each one on the front end. And then you see the average. Okay, so we always do a conservative 5-year hold. So we were projecting a 5-year hold. For all of these, we were on average projecting a 1.9 equity multiple, meaning you invest 100K, we give you your 100K back plus 90K of profits over 5 years, and just over a 15 IRR. You see here actual performance in the dark blue. We more than doubled investor money in about a year and a half on average, over a 70% IRR. So we drastically exceeded our projections in less than half the time. And of course, the market's been strong, right? And so, the market makes everybody look smart, when we've been benefactors of that too, no doubt, right? But if you look at any other sponsor the last few years in the country, we haven't seen anybody that's been operating at the same time as us with this many deals and these strong of returns. And it's a combination of sourcing these deals at a good basis, executing a business plan ahead of schedule, having a lot of operational infrastructure in place, and then, structuring the debt responsibly. And so I've been telling investors for the last year, don't expect us to double your money in 18 to 24 months anymore. Okay. It's just not realistic with where interest rates have gone, organic rent growth, really decelerating, but we've never projected that, right? It's always been a 5-year projection. We still feel very confident we can hit or exceed our projections in the model because we've always had a 5-year conservative stress test in place. So just kind of goes to show you, we've always exceeded it, and we feel confident we'll meet or exceed the projected returns for this deal. With that said, let's jump into the business plan for this deal. So like we said, 176 units. This is a B-class asset in a B-plus location, built in 1983, 100% classic interiors. We're getting the deal at over a 20% discount from what it would have sold for first half of last year because the seller is feeling a lot of interest rate pressure. They have an interest rate cap that is expiring soon. Freddie Mac is requiring escrows that are wiping out all of their cash flow. They need to get out of the deal before this interest rate cap expires because their interest rate will balloon up to over 8%, once this cap expires, and then they'll be in really big trouble. And this Bedford submarket's a great location. Like we mentioned, we own a deal a mile down the street, and there's a lot of major employment hubs, a lot of young professionals who make good money. And so this unit mix is very ideal for this type of location where you've got majority 1 bedroom, 73% 1 bedrooms, and you also have 27% 2 bedrooms for those who want 2 bedrooms. These are very large 1 bedroom units at 722 square feet on average. And you've got, a fully amenitized asset. You've got a leasing office, clubhouse, pool, laundry, business center. Like we talked about, there's a lot of upside here by renovating 100% of the units. And in addition to that, there's operational upside by the fact that the seller has not been pushing rents up to market the past couple years. Okay, they haven't been keeping up with organic rent growth. So we can be pushing rents up each month as these leases expire without really having to do much, okay? Just because the rents are already below market. And then we can renovate them and push them up even more to what other renovated product is achieving in the market. And I know Joe and I talked before the presentation, some of these I might seem like I'm going through very quickly because we don't want, this to be like an hour-long presentation, otherwise it easily could be. So we'll try to get through some of this quickly. I'll try to spend more time on some of the slides that seem, more important. But of course, you guys will have these materials. You can kind of review it. And so offering summary here, we're buying the property for $25 million, raising just over $12.7 million of equity, $50,000 minimum investment. It's a 2 to 5 year projected hold period. We talked about the great location. You've got the Texas Health Harris Hospital just 2 miles away, over 1,600 employees. You have DFW Airport, has over 2,400 employees within 10 minutes. And then we talked about the asset we already own, Rise Bedford Lake. We showed you guys earlier the value add opportunity and what those finishes look like that we'll be renovating to. Okay, so we're going to take the entire unit, strip it down to the studs, and we're going to put in brand new gray vinyl plank flooring, quartz countertops, stainless steel appliances, new cabinet boxes, etc. So when we're done, it'll look like a Class A luxury interior finish, but it'll be in that affordable workforce housing product, so we can push those rents up, increase the value. And then like we do with every single asset, we performed a full due diligence on the property. So our property management staff, our employees, walked every single interior unit. I was out there for the DD. Asset looks really nice. And to his credit, the seller's credit, he's taken very good care of it. There's no major deferred maintenance. We do have budget in place for anything that may come up in the future, like we always do. But it's a nice, clean asset, which simply just needs to have improved operations. And we just need to renovate the interior so we can get that premium rent. Here you see some facts on the Dallas market. Dallas-Fort Worth ranked #1 in the country for population growth from 2020 to 2021. It's now the 9th most populous city in the United States, according to U.S. Census Bureau. You still have strong organic rent growth, 4.4%, trailing 12. You see occupancy is slated to remain very strong, 95%. And then, it's a sad reality in Dallas and Phoenix and most of the country, but it's something to keep aware of. The median listing price of a single family home is now $435,000. The reality is that the bulk of the demographic will never buy a home. Okay, there's no way they're going to be able to afford it. They don't have the down payment for the cash, and especially now that interest rates have gone up, they especially don't meet the debt to income ratio requirements. Okay, so what does that mean? Is that people have no choice but to rent apartments, and they're going to want to rent affordable apartment buildings with nice interior finishes. Okay, that's what we provide. Okay, so we really are catering the bulk of the demographics. So as investors, we can benefit from a demographical trend where people just simply can't afford to buy homes and they have no choice but to rent. You see Dallas-Fort Worth is ranked #2 for job growth in the U.S. last year and is expected to add over 242,000 new jobs last year. And so you've just got all these people pouring into Dallas, all these jobs coming here. And whenever we're looking at a market, those are the two biggest factors we look at. What are the jobs? What are the population? Because when you have people and they have jobs, they pay their rent, right? And we want diversified employment so that you're insulated towards a downturn. And Dallas and Phoenix, top 2 markets in the country, in our opinion, and that's why we focus on these markets. We really like Dallas. Here you see area highlights. And so if you look at this map right here, you see here the yellow dot is our office in downtown Dallas. Right over here was our first acquisition. We just bought this other deal last week. And then the red dot is our target property we're talking about today. So it's literally a mile away. And we'll continue to buy deals in this infill Dallas metro. We want to really be near all of the major employment hubs. You see here some sub-market statistics. Trailing 12, rent growth and occupancy have been very strong. And even with an economic downturn and a recession where, many markets are tanking, Dallas continues to forecast strong occupancy, strong rent growth because of, the population growth and the job growth. Okay, here you see some investment options. And so, and remind me again, Joe, are you guys offering a cash flow class, or is it mostly is it going to be this middle class right here?
Yeah, we're mainly doing Class B shares, but I would say that if somebody is interested in Class A, I don't see why we couldn't do that.
Yeah, we can offer that. So for the purposes of anybody watching this presentation, focus on Class A and Class B here. And so you have, Class A is an option for you, which is a cash flow class. Okay, this is $50,000 minimum investment. This is really for people who are focused on higher cash flow. You're going to get 10% preferred cash on cash per year right out of the gates. Okay. So again, this is a $50,000 minimum. If you invest 50K, you'll get $5,000 a year paid out in equal monthly installments. Then when we sell the deal, we're going to give you your initial 50K back. So you have no upside. So this is for people who are more conservative, just want higher cash flow during the investment. Class B is our most common investment class. It's a $50,000 minimum. This is a growth class. Okay. So you have a 7% preferred cash on cash, which accrues. So it's a 100-0 split between the passive investor and us, the sponsor, until your preferred return is caught up. So 100% of cash flow, 100% of equity goes to you, the passive investor. You know, we, the sponsor at UPC and Rise 48, we receive zero cash flow, zero equity until we've actually executed the business plan and achieved a capital event like a sale or a refinance. At that point, we have to give you your entire 50K back. We have to fully catch you up on 7% per year on that money. And then after those two events have occurred, all remaining proceeds are split 70-30. 70% goes to you, the passive investor, 30% goes to us, the sponsor. Then we have a second hurdle in here, which is if we hit a 2x equity multiple net to the investor. So if we double your money, any proceeds over that, if there are any additional proceeds, we split 50-50. Okay. And the thinking there is that we've exceeded the expectations and split the upside accordingly. So as an investor, you have a 7% preferred return, 70-30 split over that, 50-50, anything over 2x. And those are your options here, Class A and Class B, by investing through UPC. Here you see a projected return summary. This is for that growth class. So again, we've always drastically exceeded our projections. And you see here, we're conservatively projecting to achieve a 2x multiple over 5 years. So projecting to double your money over 5 years, 6.3% average annual cash flow per year over the 5 years, 19.9% average annual return per year over the 5 years, and then a 15.9% internal rate of return, or IRR. Here you see projected return summary. This shows you the breakdown of your actual cash flow years 1 through 5, okay, for these two classes. And so if you see here, you know, these deals don't start out cash flowing 7% in year 1. Okay. It typically they always start out 4% in year 1 because it's a value add deal. We're renovating units, increasing the rents, and it starts to trend up. Right. So if you see here in year 1, this is using $100,000 minimum investment just for easy math. Okay. You're going to make 4% in year 1, which is $4,000 on 100K. But if you have a preferred return of 7%, and in year 1, I give you 4%, in year 2, I owe you 3% from year 1, plus another 7% for year 2. So that just continues to accrue. Okay. And so basically your preferred return of 7% is accruing. Once we sell the deal, we'll give you your initial investment back, fully catch you up on 7. And then we'll go through those splits, those equity splits that we talked about. Okay. So this just shows you actual cash flow. Whereas with the cash flow class, you'll get that 10% in year 1 each year. And then when we sell, you get your initial investment back. Here you see some rent growth projections. So we always like to be very transparent with investors for what assumptions we're using in the underwriting model when we're underwriting these deals and projecting returns to investors. So I'll first focus on these data points on the right-hand side. Here you see the 10-year historical rent growth year over year, according to RealPage for Dallas. So it's been 5.6% organic average rent growth year over year the last 10 years, trailing 12 inflation most recently. This actually just this is 5% most recently. For Dallas, it was 5.8%. And then you see trailing 12 rent growth in Dallas, 4.4% the last 12 months. Here you see, like, look at the bottom here. We are projecting 0% organic rent growth in year 1 in this model. RealPage is projecting 4.7% organic rent growth. And so we're much more conservative than them. RealPage is one of the leading multifamily analytics companies. RealPage and CoStar, you know, we pay tens of thousands of dollars to both of these companies each year for their data. We've got subscriptions to both. And so we want to show you that, you know, RealPage is projecting 4.7 in year 1. We're projecting 0. RealPage is projecting 3.9%, you know, the next 4 to 5 years or so. We're projecting just 3.1%. Okay. So this is illustrated by these horizontal lines here. RealPage is the orange horizontal dotted line, and then we are in the blue. So we're more conservative than what these leading multifamily analytics companies are forecasting for our assumptions in this deal. Okay, we want to have a risk adjusted stress test built into this model. This slide is the same data laid out in a different format. Okay, so on the left here, you have historical data. This is trailing 12 rent growth. This is 10-year rent growth. Everything here is forward looking. You have RealPage, the next 4 to 5 years is saying 3.9% organic rent growth. CoStar goes 3 years forward, 6.1% organic rent growth. We're at just 3%. Okay, so we're lower than both of these data sources. And then we're below RealPage for year one with 0% organic rent growth. So as you see here, we're more conservative than both of these data points or these data sources for our forward-looking forecasts. Here you see a sensitivity analysis for if you change stabilized rent growth or the exit cap, how it affects the equity multiple projections. So you guys can look at this in the deck, when you get a chance. Let's talk about the investment here. So we talked about the interiors. We also are going to really completely rebrand the exterior of this asset. Okay, so it's currently called Cambria Crossing. We're going to rename it to Rise Oak Creek. We're going to do a brand new monument sign with an LED backlight, which helps the curb appeal, leasing activity, new marketing banners, landscaping, 3-tone exterior paint, restore the pool deck, new sail shades, new pool furniture, renovate all the interiors like we talked about. And then we always have reserve funds in place to make any repairs to some of these larger items like air conditioners, plumbing, electrical, things like that. Here you see the interior renovation scope. And so this is one of our assets here on the top, the before photo of in Phoenix, very similar, a 1980s deal, original cabinets, white appliances, countertops. We showed you earlier what the end product looks like for renovation. So quartz countertops, stainless steel appliances, brand new cabinet boxes. This is the same materials that we do in every single deal, okay, for Phoenix and Dallas, because we have the same supplier, same materials, same fixed pricing for our supply chain. Here you see a CapEx budget. We're conservatively budgeting $16,500 a unit. We always come in below that, so we know that that's very conservative. We're budgeting just over $2.9 million. Then you see here all the exterior renovation budget. We're spending just over $600K there. Here you'll see a construction management fee. Just to be very clear, this fee is not paid by investors, okay? The lender pays us this fee because we do all the construction management and buy our materials up front. This helps us to cover our overhead. So all of this CapEx is financed by the lender, okay? So we're not raising CapEx money from investors as equity. How it works is that we have cash reserves, and that right when we close, we immediately start renovating interiors and exteriors. And then either monthly or quarterly, depending on our pace, we submit draws to the lender to reimburse us for what we've spent. So the lender has already reviewed this entire CapEx budget and approved it. And so they're basically paying us 5% of whatever we end up spending to help cover our overhead on our construction management company. So this is not paid by the investors. And assuming we get through all the interiors and we don't sell before then, we're at about a $5.3 million total CapEx budget. Okay, let's talk about the debt finance. It's probably the most important slide in the entire deck here, okay? And so obviously with interest rates, everything going on in the economy. And so to give people an idea, we've done a variety of different loan structures over the 42 deals that we purchased. We've done 10-year Freddie Mac fixed rate. We've done 10-year Freddie Mac floating rate. We've done debt fund bridge loans. We know the pros and the cons of all these deals. We've purchased deals and we've exited deals with all three of those types of loan product, okay? So we've really experienced through trial and error what is best. And we feel very confident that the type of debt structure that we're putting on this deal is the most conservative and offers the best returns for investors with the business plan we have. So this is what's called a debt fund bridge loan. And a reason we've never done capital calls and we're in good shape, we've always been lower leverage. Okay, so this is a low leverage loan, 70% loan to value, meaning we'll have a 30% cash down payment. We're not over leveraged here. We'll have a healthy amount of equity. You see here, the lender is financing 100% of the CapEx and what's called future funding. So this is not financed up front, okay? As we're spending money and renovating, they reimburse us for what we've done at that time. And every time we spend money, we're renovating, we're increasing the value of the asset, okay? You can see here, this is a 3+1+1 term, which means a 3-year term with 2 1-year extensions. So we can make it a 4 or a 5-year loan term. It's interest only for the entire term of the loan. Okay, so we don't have to pay principal payments, which really helps with investor cash flow. And this is what's called a floating rate loan. Okay, so some of you are probably thinking, why would you do a floating rate loan when the Fed keeps aggressively increasing the interest rates? Why wouldn't you do a fixed rate loan? Okay, so we'll explain to you how we mitigate against the floating rate loan. But first, we'll talk about why do we do that? Okay, so again, give you guys an idea, we've done fixed rate financing, we've done floating rate financing. A lot of people don't realize is that whenever you take a fixed rate loan, whether it's Freddie Mac, a bank, whomever, the lender has exposure there, because when they're guaranteeing that your interest rate won't change, well, interest rates can go up in the market and then they get hit, right? That the way that lenders protect themselves with a fixed rate loan is they hit you with a really nasty prepay penalty to cover themselves in case rates go up. Okay, so as an example, and these prepay penalties are typically called yield maintenance or defeasance. Okay, so as an example, we did this. We did 2 Freddie Mac fixed rate loans. They were 2 of our earliest deals, and it was a mistake. Frankly, we regret doing it, but we didn't have experience at the time. In 2019, we bought a deal, and it was $17 million purchase price. Okay, we got through 50% of the interiors, exceeded all our pro forma rents. We're doing a really good job. In 2021, just 2 years later, we go to sell the deal. We had yield maintenance prepay penalty. We had a $3 million prepay penalty right off the top. $3 million of cash right out of investors' pockets and away from the profits. When we realized that, we had to hold that deal 8 months longer than we wanted to, just so we can continue to renovate units, increase the value, and still sell to absorb this massive prepay penalty and still net out the investors the 2x return. Okay, so yield maintenance means that if it's a 10-year term, if you sell in year 2, the lender is going to make the entire yield they would have made on that loan as if you owned it for 10 years. Okay, so that is the trade-off with fixed rate financing. It's really only a good loan product if your business plan is to buy like a newer Class A vintage deal and hold it for 10 years. Okay, it's not good or advantageous for these value add deals where we're increasing the value and then wanting to sell it to realize a strong return for investors. And so the reason we do a floating rate loan is because you get very flexible prepay penalties with the floating rate loan. As you can see here, the lender just wants to see 6 months of total interest payments, which means that if you own the deal for just 6 months, you could sell or refinance. You have no prepay penalty whatsoever. Now, we would never sell or refi in less than 12 months. We don't want investors to get hit with short-term capital gains tax. But if we own the deal for 12 months, we can sell or refinance and have no prepay penalty whatsoever and truly maximize investor returns upon that exit. Okay, and so we've learned this through trial and error. The way that we mitigate against this floating interest rate is we buy a low interest rate cap on the front end. Okay, so we're buying what's called an interest rate cap, where our maximum interest rate is 4.75% for the first 3 years of this deal. No matter what happens with the Fed, the Treasury, the indexes, our interest rate cannot exceed 4.75%. So what we've done here is we've effectively engineered a fixed rate loan by buying this low interest rate cap on the front end. Okay, so just like with a single family home, some of you may have done this where you can buy points or you buy down your interest rate. That's basically what we're doing. Okay, we're saying, okay, we're going to pay for this interest rate cap on the front end so that our projected returns are assuming this max interest rate of 4.75%. And then we can actually underwrite our prepay penalties on the back end. Okay, this is the best way to do it to protect ourselves. And so you can kind of see here, this explanation down here shows you the returns we're showing you are projecting that max interest rate. This is a 3-year interest rate cap. Okay, some of you may be thinking, what happens after 3 years? Okay, you have 3 options. Before the end of year 3, the first option and most likely scenario is, let's just say interest rates do not come down the next 3 years for whatever reason. They are projected to get cut aggressively, next year at the latest, but let's say they don't come down. Well, even if rates don't come down, we feel confident that we can drastically increase the revenue and the net operating income of this asset by doing the value add and burning off the loss to lease, so that when we have higher NOI, we qualify for more loan proceeds, so that before the end of year 3, we can refinance into a 10-year Freddie Mac floating rate. And we'll use those Freddie Mac floating rate proceeds to pay off the first loan and then buy another 3-year interest rate cap. And we do a Freddie Mac floating rate, not a fixed rate, because we don't want to get hit with that nasty prepay for the new loan. Okay, we've done Freddie Mac floating rate as well. Okay, and you can buy another cap. So basically we use the new loan proceeds, pay off the first loan, buy a new cap. Okay, second option is that we're raising significant cash reserves at the property level. If for some reason we can't refi by the end of year 3, we can use our cash reserves to buy another cap. Okay. Third option is that we could sell the deal before the end of year 3. We're not banking on that or relying on that in the model, but it could be a probable option. Okay, if we can get a good return. So anyways, we structure the loan this way give ourselves, maximize returns upon the exit, but mitigate interest rate risk by buying this low interest rate cap on the front end. Here you see an interest rate sensitivity analysis. It shows you the projected returns. We used to, before interest rates shot up, we used to show investors what your return looked like with a different spectrum of interest rates. But we don't think it's realistic rates will drop below 4.75%. And so we're showing you the returns that we're showing you are assuming that max rate. Okay, that's why we buy this low interest rate cap. And you kind of see here down here an explanation of the interest rate. Here you see a summary of the exit strategy we just talked about. Let's talk about the asset itself. So $25 million purchase price, 14 buildings, 176 units, very large units, especially for one bedroom, 722 square feet, 1980s vintage, individual air conditioners, brick construction, pitch shingle roof. So all the characteristics we typically look for in these opportunities. Here you see a 2021 renovations case study, okay? And so this represents 15 different properties we bought in 2021. Each one of these two bars represents one asset. The striped bar was the projected pro forma rent we were assuming to hit before we bought the deal. So just like in this property, we're going to show you soon that we're projecting to renovate the unit and increase the rent to X. Okay, that is what the striped bar is. The solid blue line is what we actually achieved in the rent. As you can see here, for every single asset across these 15 properties, over 400 units, we not only met the projected rent, we drastically exceeded it by an average of $73 per unit. What does that do? That increases your NOI and your value significantly, and it collapses a time frame of when you can sell. If you took a conservative 4.7 exit cap rate for this asset, let's just say on this property we're talking about, we exceed our pro forma rents by $73 per unit, that would add over $19,000 of value added for each unit, which times 176 units is over $3 million of additional value that we can create. To be clear, we are not assuming that in this model, but it's showing you based on past performance, the type of upside there is if we exceed our pro forma rents. And as you can see, these first 5 properties, they've already been sold. These are all home runs for investors because we exceeded them so much. And some of you might be thinking, well, that's great, but in 2021, organic rent growth was really strong. The market was strong. In 2022, we saw organic rent growth normalize and decelerate across the country. Okay, so since that post-COVID surge ended. So we wanted to show you in 2022, we renovated even more units than 2021. We renovated 600 plus units across 11 assets. Every single deal, we exceeded our projected rents by an average of $48 per unit. If we were to hit this, we had over $2 million of additional value to the asset. So again, we're not including this, but it just shows you we have very conservative pro forma rents. We've always been able to meet or exceed them. We've renovated over 1,000 plus units in the last 24 months. And even just the last few months, we've been increasing velocity. We've renovated 600 units the last 3 months. Okay, we're hitting and exceeding our projected rents on every single unit. Here you see a unit mix slide, shows you the breakdown, 73% one bedrooms, 27% two bedrooms. This horizontal bar down here shows you the total breakdown of rental increase as it relates to a concentration of loss to lease and renovation premium. So in the dark blue here, loss to lease, this represents operational upside. Okay, loss to lease means that without doing anything, these units that have not been renovated are conservatively $105 below market compared to other units in the immediate area within 3 miles that have not been renovated. And we know this from personally secret shopping all the comparable properties. Okay, this is the most loss to lease that we've seen in at least a couple years on a deal out of over 30 plus deals. As you can see, more than 50% of our entire rental increase is just loss to lease alone, which means that these are all 12-month leases, right? They're all signed at different times throughout the year. Every single month, you're going to have X amount of leases that are expiring. And every single month when those leases expire, we're going to tell the tenant, hey, we'll renew you, but you're automatically getting a $105 rental increase because that's the market. And if they get upset, they'll go drive around and they'll realize, oh, there's nothing cheaper. And we already know that because we've shopped the comps. So over a 50% increase just through loss to lease, operational upside. And then for those units that we're going to renovate, we can get an additional $89 premium conservatively by taking up to that renovated product, which is already being achieved in this submarket. So you can see here, it's a conservative plan because it's really like a hybrid approach of operational upside and value add upside. Let's jump into the financial analysis now. Some of the key assumptions of all the underwriting. So like we said, $25 million purchase price. It's 94% occupied. raising about $12.7 million of equity. You see here a full sources and uses of capital. This will be available on the deck, so I won't go through all of that. You see a summary of the return structure and classes down below. We talked about that Class B growth class. You have a 7% preferred return, 70-30 over that, 50-50, anything over a 2x. And then you see here the 5-year pro forma. Okay, so this kind of shows you the P&L for those first 5 years. I won't go through all of this, but what I'll focus on here is the total rental revenue year over year change. Okay, so if you look here, we're not realizing the bulk of the increase until the end of year 2. Okay, we're assuming very modest increases in year 1. This is from a conservative underwriting perspective. We're saying that in year 1, even though we're going to be renovating and increasing rents and burning off loss to lease, we know there will be turnover, right? Because we have to renovate the units, we have to, penetrate the rent roll. We're saying it's going to take 2 full years to fully penetrate the rent roll, burn off the loss to lease, and renovate all those units. So we're realizing the bulk of it in the model by the end of year 2. In reality, we typically always see significantly higher rental revenue percentage in year 1. Okay, that's in reality. But from a conservative risk-adjusted model, we say it's going to take 2 years to realize the bulk of that. Okay, so that gives you some insight there. Underwriting assumptions, economic occupancy is a combination of physical occupancy and delinquency, loss to lease, bad debt. Rental growth, we showed you our transparent assumptions for rental growth, how we're more conservative than both CoStar and RealPage. We're assuming 0% organic rent growth in year 1 because we're in an economic downturn. So very conservative assumptions here. Expense assumptions, we always hit our operating expense assumptions because we own the property management company. We don't use third-party management like most people. And that's why we created our company, right? The property management company is not a big profit center, okay? We just need to break even there. We want to have control, make sure we hit our budgets so that the property performs well, investors get good returns, and then we make our money as sponsors. Our high profit margin business is from the equity company, okay, once the asset performs. So we always hit these expense assumptions. And then we showed you our interest rate assumptions, how we're buying that low 4.75% interest rate cap so we can mitigate the risk there. Okay, so those of you who are familiar with Texas, you know that property taxes in Texas can be a nightmare. Okay, so Texas does not have a state income tax. What they do is they compensate for that and gouge you with property taxes. Okay, and so we've known this for years. We have over 4,000 investors who've invested with us so far, and we've heard horror stories of them investing with sponsors who did not assume significant property tax increases, and then when it happens, it completely blows up the underwriting model. It impacts their returns negatively. And so before we ever pursued any deals, we did thorough due diligence on who are the best tax consultants in the market. We asked multiple lenders, debt brokers, investment sales guys, other sponsors, and we kept getting pointed back to CMI, Cantrell McCulloch Incorporated. Okay, so this is our tax consultant. Basically what they do is they give you forecasts for what you should conservatively project. And they're right now a consultant for like tens of thousands of units. So like one of the biggest companies, but it's a local guy. I talk to Mark Cantrell, the owner, myself all the time. And they have a pulse on where the counties are doing with these tax rates. They're also a litigation attorney firm. So every year we're going to basically contest our property taxes and threaten to sue the county, because what happens is it's a cat and mouse game. Okay. And it's blatantly ridiculous now. But what happens is that the county will hit you with this ridiculously high tax reassessment. CMI goes back to them and says, no, based on all this data and comps, you guys are overshooting it. It should be down here. And then you settle in the middle. Okay. And typically you don't ever actually go to litigation, but that's just how it works. And so we wanted to show investors conservatively what is our forecast for underwriting. And so what we're doing is we're taking the current market value of the asset. We're taking 90% of the market value of the asset in year 1, multiplying it by the estimated tax rate. Year 2, we take 95% of the market value and multiply it by the tax rate. And year 3 is 100%. And then our stabilized years in years 4 and 5, we're increasing by 3%. So if you look at this spectrum over here, this is a forecast from CMI. Okay, they gave us 3 data points. They said, this is the best case scenario. They said the most conservative, realistic scenario that they've recommended we model was right here, 443. And they said, this is like very unrealistic, the end of their spectrum, 49. We're assuming 450K, more conservative than what they said is their most realistic. So we feel like we've built in a lot of contingency here. We're increasing the current property taxes going into our first year by over 16%. Okay, so we wanted to show you property taxes. It is so critical in Texas. The other big thing right now, many of you may have seen, it's like a national headline, is the increase in insurance costs, right? So insurance companies are really increasing right now. And so we're assuming $1,000 per unit. Our last two deals that we just closed came in below this. And so we're getting, reassurances from actual insurance carriers and our broker, GSI Insurance Solutions. And so you can see here, we're assuming a 65% increase in our insurance from what the current seller is paying to when we own it. Okay, so we have a ton of cushion here. Feel very confident that we're going to have enough budget for insurance lines. So those are two big things to be aware of when you're investing in Texas, whether it's us or anybody else: property taxes and insurance. Here you see a break-even analysis. This shows you what physical occupancy, years 1 through 5, what physical occupancy right here does the property need to stay at minimum in order to cover its own operating expenses and its debt service. Okay, and so basically you can see here that it needs to be at least 76% and stay. It starts to trend down, as we increase the revenue. The property is currently 94% physically occupied. Okay, but we have so much cash reserve. We have over 1.1 million of cash reserves that we're raising that are not allocated to anything. These are basically rainy day funds. This is separate from, CapEx reserves, interest reserves, things like that. This is just rainy day cash so that we could start out day one. And remember, it's 94% occupied now. We could start out day one when we close in 4 weeks at 69% occupancy, which would be unheard of, by the way. You'd have to completely neglect the property. But if we could stay at 69% day one and stay there for over 5 years, we have enough cash reserves in place at 69% for 5 years to never do a cash call. Okay, never do a capital call. So this is why we're in good shape right now. A lot of sponsors doing capital calls. We're lower leverage. We buy low interest rate caps. We raise plenty of cash. And so it just shows you, how conservative. Our number one priority is to never lose your money. And then after we've protected against that, we're looking at how can we structure the debt? How can we execute our plan to get you the best return? Okay, so that just kind of shows you how conservative this is. Here you see another summary of projected returns. We'll blow through this market info really quick. We'll do the rental and sales comps, and then we'll wrap it up with a Q&A session. And so like we talked about, B+ location, Bedford, you've got all these major employment hubs nearby. We talked about population growth, job growth, rent growth, the fact that people cannot afford to buy a single family home. They have no choice but to rent apartment buildings. And this is going to be, an affordable type of asset with really high quality interior finishes. Some of the major employers nearby, you've got University of Texas, Texas Instruments, AT&T. They call Dallas the headquarters of headquarters for a reason. You have all these, national, international companies are headquartered in that Dallas MSA, which is why it's such a strong market. Recent news, you have, major companies like Goldman Sachs, Samsung, Caterpillar are all, expanding, building new manufacturing facilities and expanding their operations in this market. Here you see a graphic from the U.S. Bureau of Labor Statistics. This shows you the diversification of the workforce for the Dallas market. Okay, so it shows you different industries broken down by categories. Okay, and so when we're looking for diversified employment, or when we're looking at a market, we want to see diversified employment. We don't want a market that's heavily concentrated in one industry. Like, for example, Las Vegas has been a strong growth market the last several years, but it's heavily focused on hospitality and tourism. And right now it's getting absolutely crushed. Okay, they have a lot of delinquency. I have friends that own deals in Vegas. They're suffering right now. We like Dallas because, as you can see here, there's some of these categories have multiple industries inside them. But you've got, trade, transportation, utilities, healthcare, financial services. This hasn't even really caught up to reflect all the tech job growth. But not even one industry reflects more than 21% of the concentration. So you're well diversified here. A lot of markets that struggle during downturns are heavily concentrated in construction jobs. You can see here, mining, logging, and construction makes up only less than 6% of the workforce. So this is, again, the reason why we like the Dallas market, diversified employment. Let's take it to the rental and sales comps here, and then we'll wrap it up shortly. And so what we do for every single deal we make an offer on, let alone get under contract, just make an offer on, we personally secret shop all the comps. What does that mean? That we look at similar size properties and similar vintage properties within a 3 to 5 mile radius. And we're looking at properties that have renovated units that are similar to our renovated product. Okay. And then we say, okay, what base rent, what price per square foot are they charging right now for that renovated unit? so that when we're projecting our renovated unit rents, we're going to be right in line or below what's already being achieved today. So we're not being too aggressive. Okay. So we have our real pro forma rents. Then when we close on the deal, we tell our property management staff pro forma rents that are actually 5% higher than our actual rents. We say, hey, this is the rent you need to hit. Otherwise, we'll fire you. I'm just kidding. We're not that intense, but we kind of are. And so that's why we always exceed our pro forma rents, because there's cushion built in, right? We say it's much higher, 5% higher than what we're actually trying to hit in our model. So if you see here, you have Rise Oak Creek here, and you've got, what do we have? 7 different assets within a 3-mile radius. Okay. Similar size, similar vintage. This deal, Point Loma Woods, we just bought this deal last week. Okay. So we're going to own one of the comps here. And like I said, it's a mile away. And so these are similar vintage, similar size. And we looked at 1 bedrooms and 2 bedrooms. The blue right here, the average, this is the average rent that's being achieved right now today for renovated units at these properties. Okay. This is being achieved right now. In the red, you see our post-renovation projected rent that we're projecting to hit after we buy the deal, renovate the units, and lease it up. So as you can see here, for 1 bedrooms and 2 bedrooms, we're right in line or below what's already being achieved right now. So we're not trying to, reinvent the wheel here. We're basically saying that we're going to renovate the units. We're going to achieve what people are already achieving right now. The reality is that there's hardly any of these comps that have as high of a quality of renovation scope as us, okay? Because we buy our materials directly wholesale overseas, we get much cheaper pricing. We can afford to do stainless steel appliances, quartz countertops, brand new cabinets. Most of these renovated units, they're resurfacing for mica countertops, putting in black appliances, and painting the original cabinets. And we had to do that a few years ago before we had, this wholesale buying power. So, we're just showing you here, we're not trying to reinvent the wheel. These are very conservative pro forma rents, which is why we're able to hit and exceed our projected returns. Here you see a sales comps. And so this just shows you how good of a basis we're getting on the deal. Okay, you can see deals that have recently traded in the Dallas market, similar size, similar vintage, and on average, they've been selling for $170,000 a unit. We're buying this deal for $142,000 a unit. So like we said, we have a distressed seller who has to get out of the deal before their interest rate cap expires. And so we're getting a good basis. This is also well below the median sales price of a single family home. So if you want to talk about replacement cost, single family homes, like we said, are selling for $435,000. So great value here. And then, our last slide here is acquisition timeline. Some of the key dates to be aware of. And Joe, I don't know, this is our deck. I don't know if you had slightly different dates or not for your investors. So I don't know, did these look correct to you? Did you have May 16th and May 19th, or what were your timeline?
Yeah, I would say that our timeline is roughly the same outside of what I will say, right, is that Zach has given us this great opportunity to be able to invest with their team. Granted, he doesn't need us. But Zach is all about, right, building relationships. We're all about building relationships. And so Zach has pretty much given us till next Thursday to let him know what dollar amount we're in for right now. Right now we're at roughly $500,000 in soft commits. We're working on raising to $1 million. So I would say that our deadline is going to be May 11th. So 7 days from today, that we will need commitments, and then, then everything else will be right on your screen. So.
Yep. Okay, perfect. Yeah. So basically you just need commitments by May 11th. That doesn't mean you have to sign or fund. I think that you just need to, and we can take so you're going to need to wire your money to Joe. You're going to sign Joe's documents, wire the money to Joe, and then Joe will wire to us. And yeah, I mean, if all the investors wire to you, Joe, or to UPC by May 19th, which is 2 weeks from tomorrow,
right,
then that's to be fine. Then Joe, you can wire to us the following week, because we're planning to close this deal in about 4 weeks on May 31st. Okay. So that's kind of what that looks like. And like Joe said, we do think there'll be a lot of demand. So if you're interested, and you can please fill out a soft commit. We always tell investors that we need 1 full month worth of operations before we begin the reporting. And so we're closing end of May. June is that first full month. So the last week of July, you're going to receive your full report on June's performance. And after that first report, you'll get a report every single month going forward, okay, which just shows you progress on the CapEx, the interior renovations, where the metrics are coming in at. And then we always tell investors that we conservatively begin distributions 90 days after closing. But if we can begin that sooner, then we may. Okay, so the very earliest you would get distributions would be that first week of July. It could be going into August, but we'll keep you updated there. And then we'll jump into some Q&A. I'm just going to say a few points really quick, Joe, that typically
Please.
come up, frequently asked questions. And then if you have certain questions you want to ask me, or if anybody else has questions, we can go through that now. And sometimes people don't want to ask their questions from other people, or maybe they think of it later. So if you guys want to email Joe or myself or get on a separate call, happy to do that too. But we went over kind of the schedule for distributions and reporting, so you guys have an idea there. One question we get a lot is, are these distributions treated as return on capital or return of capital? Okay, distributions are treated as return on capital, which means that every distribution you're getting each month is a profit on your initial investment. Okay, we're not drawing down your capital account as we go through these. Okay, so let's say you invest 50K, we're giving you distributions each month throughout the hold period. Once we sell, Joe has to give you your 50K back plus all your profits upon the sale. Okay, so return on capital. Another question we get is, are we doing a cost segregation study on the deal? The answer is yes. So we'll do a full cost segregation study to take full advantage of any depreciation benefits. And each year during tax season, we're going to upload your K1 into your investor portal. Okay, so we always get K1s out by end of March before the deadline. So by next March, you will get a K1 in the UPC portal that you can just download, give that to your CPA. Even though you've been making distributions, you've been receiving distributions every month throughout the year, your K1 is going to show you took a loss because you're going to receive the benefits of investing in commercial real estate. That passive loss typically always offsets any passive income that you receive. And so our investors pay virtually no taxes on their monthly cash flow. Okay, so you get the benefits of that depreciation, you're getting tax-free cash flow. And then another question we get a lot is, are the sponsors investing in the deal? The answer is yes. Okay, so we as a sponsorship group are investing a minimum of $500K to $1 million of our own personal cash in the deal. Okay, and I can tell you, I am the single biggest investor in the entire portfolio. Okay, we have over 4,000 individuals. Nobody's invested more money than me personally. I don't mean like sweat equity, I mean actual cash invested. And so we truly believe in this. We have skin in the game. Our interests are truly aligned. And Robert Bickert and I at Rise 48, we are also the guarantors on the loan. As an investor, you have zero liability with the loan or anything like that. We are signing on the loan. So I'm getting background checked every few weeks. I have to give them my last 3 years of tax returns, my last 90 days of bank statements. That's all up front. I also have to do that quarterly, after we close. And the reason I'm saying that is, in addition to all that, the lender wants my bank statements. They require that we're investing at least 2 to 5% of the total equity needed for the deal into the deal of our own personal cash, because the lender wants to make sure that we have skin in the game as well, because they're lending us tens of millions of dollars. And so just so people know, we're very aligned in that sense. And those are kind of the major things that we typically get asked, Joe. I don't know if you have specific questions or if anybody else has questions we want to go over here on the call.
Yeah, one thing that I'd like for you to talk about really quickly, one of the benefits that you guys have that I really like is that, as this deal goes on, if when the deal sells, right, and our investors have a successful experience and a great experience with you, right, that you guys have the ability, instead of our investors having to do a 1031, but you would be able to give them the opportunity to 1031 into another deal.
Correct. Yeah. Great question, Joe. Yeah, let me touch on that. It's a great question. So we ultimately want to do whatever is most tax efficient for investors and frankly for ourselves, right? Because we like the 1031. So those of you who aren't familiar with the 1031 exchange, many of you may be familiar with it from like a single family home, like your rental property. The same thing applies to these large apartment buildings. The reality is that most syndicators or sponsors across the country do not offer 1031 exchanges because it's very complex to execute mechanically, especially when you have hundreds of investors in each deal. Well, a few years ago, we engaged a couple like high-level tax attorneys to get this structure down, and we're pretty proficient with it. So of the 11 deals that we've sold, we've done 7 1031 exchanges. And the other 4 deals we didn't exchange were just earlier deals. We honestly weren't thinking of it at the time. But ever since we started, or we started to try to do it, we're 7 for 7. The plan for every deal we do, including this one, is to do a 1031 exchange upon the sale. As an investor, you have the option to participate or not. Okay, so you can choose to cash out upon a sale, which is totally fine, and we'll give you all of your initial investment back, plus all of your profit, and you pay a capital gains tax on the profit. Now, the way the capital gains taxes stand right now, the brackets are that if you make more than 500K in a year, through any of your income sources, you pay a 20% capital gains tax. If you make less than 500K, it's a 15% tax. So you always have the option to cash out, or you can choose to participate in the 1031 exchange. You would roll all of your initial investment into the new deal. So let's just say you invest 50K. You'd roll all your initial 50K into the new deal. And let's say we doubled the money. And then you would roll your 50K of profit into the new deal. You will defer the capital gains tax. So you pay no capital gains tax on your 50K profit. And now your preferred return of 7% is now on your new investment basis of 100K instead of 50K. So it's a very powerful vehicle because we grow the money in a short amount of time. You pay no capital gains tax. You drastically increase your monthly cash flow because your preferred return is on a higher basis, 7% on 100K instead of 50K. And then because of the depreciation, you pay no taxes on the cash flow. Okay, so it's a very powerful tax efficient vehicle. Our goal is to never break the 1031 chain. If you invest 50K today, our goal is to 1031 exchange that thing 6 or 7 times the next 30 years. Okay, and you can cash out at any point upon a sale if you want to, or you can keep it rolling. And you have an option where right now the way the tax code reads is that when you die, you can will your interest to your kids, and they can inherit it, and they can just cash it out, and they get what's called a step up in basis. They don't have to pay any of the capital gains taxes that followed you. Okay, and so that's what some of the wealthiest families have been doing now for generations, is they just keep rolling the money and then they will it to their next generation, and then so on and so forth. And so that is our strategy here. It's a long-term strategy. We want to continue to 1031 these things and be tax efficient.
That's great. Yeah, thank you for that. Does anybody else have any questions?
Yeah, and people can email us too, Joe. So you guys can set up a call with Joe and I, email Joe and I, and happy to answer questions that way as well. But yeah, I mean, we really think it'll be a good investment opportunity. If anybody's ever in Phoenix or Dallas and you want to meet up with me, feel free to reach out, meet us at either one of our offices, and look forward to partnering with you guys.
Yeah, I'm gonna have to come say hi tomorrow or Saturday. I'll be there at midnight tonight in Scottsdale.
Okay, there you go. All right, perfect. I'll meet you at the airport midnight tonight, Joe. We'll see you there.
Okay, hey, you can be my Uber if you want to be.
There you go. Yeah, okay, there you go. We'll talk later. Let me check my schedule.
Okay, see if you're sleeping or not.
That's right.
Okay.
Cool. Thanks so much, guys. Appreciate your time, and let me know if any questions come up, and we'll talk to you soon.
Okay. Thank you for jumping on, Zach. Thank you, everybody, and appreciate your time. And we'll be reaching out, or reach out to myself, Michael, Brandon, or Christine, and we'll be sending the deck out along with this recording. So talk to everybody soon. Have a great night.
Thanks, guys.
Thanks, Joe.
Thank you.